They say that a penny saved is a penny earned. On your wealth building journey, you always want to reduce your expenses and thereby increase your cash flow and ultimately your net worth. In this video, we're talking about 5 strategies to slash your tax bill and keep more of your hard-earned cash. And if you stick around until the very end, I'll give you a 6th bonus strategy that I guarantee most of you have probably never heard of. 6 ways to reduce your biggest single expense, your income taxes. That's the topic of today's video, right after the intro.
1877 Levy King, Levy Levy King, 1877 Levy King, levyking.com.
You know, making money is great, but if you don't learn how to manage your tax bill, you're going to owe larger and larger sums of money to the government in the form of taxes. As you make more money, you'll owe more money. And for top earners, the total tax burden can be as high as 50%, including both federal and state taxes. And who really wants to give half of your hard-earned money to the government? So without further ado, here are the top 5 investments to reduce your tax bill. The first strategy is a very simple one. We're probably all familiar with is the traditional 401k. A 401k plan is a defined contribution plan offered through your employer or through your own business. Defined contribution means that you know exactly how much you're putting into the plan during your working years, but you don't know how much you're going to get out of the plan during your retirement years. Currently, you can contribute about $23,500 into a 401k, although this amount changes frequently. Now, if you're over the age of 50, you can contribute an additional $7,500 into your plan. If you're over the age of 60, you can contribute an additional $11,250 into the plan. There are 2 big tax-saving benefits to the 401k. The first is that your contributions into the plan reduce your income dollar for dollar. So if you earn $100,000 a year and you contribute $25,000 into your 401k, your taxable income is now only $75,000. The second tax benefit has to do with the employer match. As a business owner, we often wear 2 hats. There's the owner's hat, but there's also the employee hat. If you contribute $25,000 into your own 401k wearing your employee hat, you can make a matching contribution of $25,000 also into your 401k using your employer hat. And both contributions are going to be tax deductible. So in other words, if you're self-employed, you can make an employee contribution and also an employer matching contribution into your 401k and claim both contributions on your tax return. So how much is that employer matching contribution? An employer can contribute up to 100% of the employee's compensation, but there is an overall limit of $70,000 or $77,500 for those age 50 or older in terms of catch-up contributions. Next up is the traditional IRA or individual retirement account. An IRA can be set up at any financial institution like Fidelity or Vanguard. You can even go into your local bank like a Bank of America or Wells Fargo. There is no age requirement and no income limitation. All you need to have is what they call earned income. An IRA is something you set up yourself. So the earned income could be from a W-2 job, but it doesn't have to be. It can also be from a small business that you own or even from a side hustle. So right now you can contribute up to $7,000 to a traditional IRA or $8,000 if you're age 50 or older. One of my favorite things about an IRA is that you can make the contribution this year and get a tax deduction for last year. So if you're watching this video and looking for some last minute tax deductions, you have up until April 15th of the current year to make that contribution and still have it count for last year's taxes. You can also set up IRA accounts for your kid. They can also invest $7,000 per year if they have earned income. Now, check out my video explaining how to put your kids on payroll if you own a small business. Once your IRA accounts are set up, you can also invest into stocks, bonds, CDs, even into real estate to grow your wealth. The assets within the account are going to grow tax deferred, meaning that you don't have to pay taxes on those assets while they're inside the account, but you will be taxed when you withdraw those assets in retirement. The one big downside to an IRA is that your tax deduction is going to be limited or even disallowed if you're covered by a workplace retirement plan like a 401k. So for example, if you're a single taxpayer with income that's over $87,000, or you're married filing a joint married tax return and your income is above $143,000, you can still have an IRA, but you're not going to get a tax deduction if your employer offers a retirement plan like a 401k. Next up is the health savings account, or HSA. An HSA is another account where you receive a tax deduction for making an investment into the account. Where an HSA is going to differ from a retirement account is how you use or access the money while you're still working. With an HSA, you can actually use the money during your working years on health-related expenses, including things like doctor's visits, vision care, dental care, prescriptions, physical therapy, etc. In 2025, a married couple can contribute up to $8,500 and a single person can contribute up to $4,300 into the plan. If you're over the age of 55, you can contribute an additional $1,000 each year. The HSA also offers some powerful tax saving benefits. You can deduct the amount you deposit into an HSA from your taxable income, whether you itemize deductions or not. If your employer contributes to your HSA, or if you contribute through payroll deductions, these contributions are tax or pre-tax or tax-free to you, meaning that they're going to reduce your taxable income. HSA funds can be invested in a variety of investment options. You got stocks, you got bonds, mutual funds, and ETFs, etc. Any interest or investment gains earned with an HSA are going to be tax-free. Withdrawals that are used for qualified medical expenses during your working years are also tax-free. But best of all, once you turn 65, you can withdraw funds from your HSA for any reason without penalty. They're going to be subject to tax, but you won't incur a penalty for withdrawing the money. Now, don't confuse a health spending account, or HSA, with a flexible savings account, or FSA. The FSA is subject to what they call use it or lose it rules, which means you have to use all of the money you've contributed during that year or forfeit whatever's left over at the end. HSAs are not subject to the rule, which means that those funds can be left to accumulate year over year. I love HSAs because if you set them up properly, your money is never going to be taxed. You can claim a tax deduction for your contributions. You can invest in mutual funds or ETFs or whatever, and the gains are going to grow tax-free. You can also withdraw your money tax-free after the age of 65. I personally think that health savings accounts are great tools, great options, and more people should use them. Number 4 is small business ownership. Owning a small business is the fastest way to build wealth. It's hard to imagine a faster way to get rich than owning a small business in the free market system. But owning a small business is also one of the fastest ways to reduce your taxes and maybe even cut your tax burden to zero. To understand why this is, you got to understand how the government taxes employees versus owners. When employees earn money, the government taxes the income before the employee even receives it. Whatever is left over is available to the employee to pay his tax bills and his expenses. But it's different with owners. Owners generate income, then pay their expenses such as salaries, overhead, etc., and the government gets whatever is left over, if anything at all. So in other words, you have the ability to pay taxes after deducting all of your expenses, whereas most people pay taxes first and use whatever is left over to pay for their lifestyle expenses. So by deducting your expenses first, business owners are able to report less taxable income and thereby pay less taxes. The tax law allows business owners to essentially write off almost anything as long as it has a business purpose. You can write off a portion of your rent or your mortgage, your utilities, your vehicles, health expenses, meals, travel, etc. This is going to help you to lower your overall taxable income, even your W-2 income. That's right. Losses that you generate by owning a business can help you offset some of the taxes you're going to owe from your job. And that's whether you have a side hustle or a business and you're able to take a loss in that business because maybe you haven't gotten your business profitable yet. You can utilize that loss to offset your W-2 wages. Number 5 is real estate. Most people know that real estate is one of the best tax shelters in the world. There are opportunity zone credits. You got the mortgage interest deduction. You got property tax deductions, opportunity zone credits. They've already said those. You got tax deferred exchanges when you're ready to get rid of the property, cost segregation, just to name a few. The list goes on and on. But 2 of the biggest benefits are what they call the qualified business income tax deduction and depreciation. Now, qualified business income, or QBI, and with the QBI deduction, most self-employed taxpayers and small business owners can exclude up to 20% of their qualified business income from federal income tax, and that's whether they itemize or not. Now, when it comes to depreciation is a non-cash expense, meaning that you get to claim the expense on your tax return, but you don't actually have to spend any cash out of pocket. Depreciation is a method for recovering the cost of an asset. In this case, the asset is real estate, right? And you're going to recover the cost of that asset over its useful life, instead of deducting the entire cost of the property in the year of the purchase. Depreciation allows you to deduct a portion of the cost each and every year. So here's an example. Let's say you purchase an investment property for $500,000 with a depreciable basis of $400,000. That property could result in depreciation of $15,000 to $20,000 per year, every single year for up to 40 years, or as long as you own the property. That means you're going to get a $15,000 to $20,000 write-off every single year on your personal tax return because you bought a piece of investment property. Now, because of all these deductions and depreciation, real estate investors are often able to report losses on their tax returns despite earning actual rental income from their tenants. All right, guys, told you I'd have a bonus for number 6, and here we go. Number 6 is what they call donor advised funds. If you give money to charity, or if you plan on giving money to charities in the future, whether it's the school you went to, organizations you belong to, or maybe even your church, you really should look into what they call donor advised funds. A donor advised fund is an account that you can use to accumulate funds for future charitable gifts. When you give money to any charity or nonprofit, you're going to receive a tax deduction, and the charity is going to get the donation itself. But when you give money to a donor advised fund, you would receive an immediate tax deduction based on your contribution. But what if you want to make the contribution in a future year? Generally, you can't claim a deduction until the year that you actually make the gift or the contribution. But with a donor advised fund, you can claim the deduction now, even though the charity won't get the gift until 5, 10, 20 years later. There are many, many strategies to reduce your tax burden. These definitely aren't all of them, and I can't say that these are the best strategies for you, but to figure out which strategies are going to work best in your particular situation, you need to sit down with a good advisor. If you'd like to book an appointment with myself or my team, please give us a call at 1-877-538-9546. That number again is 1-877-538-9546. You can book an appointment by visiting www.legacytf.as.me or just click the link below. Schedule a date and time and we'll give you a call. It's that simple. Well, that's it for this week, guys. Talk to you later. Bye.
1-877-LEVY